Assalamu alaikum. Very good day to you. And at first, I would like to provide all types of praise for the Almighty Allah who has given me a chance to join such like a digital platform. And today, I'm going to take a session on common stock bonds and warrants. I hope so at the end of the session you will understand a clear concept regarding this particular issue. And here I am Muhammad Hussain, a lecturer, Department of Accounting, Government Hossain Sorority College, Magura. So let's go to the slide directly so that we may understand the respective issues directly. And this issue is based on the discussion of risks and return chapter. So dear learners, we know very well the common stock. Common stock is the key stock of the company. And common stock always goes to the benefits of the shareholders in such a way that we'll discuss on this particular facts. So, common stock, concept of common stock. Common stock is a security that represents the ownership of a corporation, also known as ordinary shares, having the right for the electing board of directors and voting rights on the corporation policy. On the corporate policy, for example, if a company issues 100 shares of the stock and an investor purchases 10 shares, he would own 10% of the company. So now characteristics of a common stock. Number one, claim on the income. Number one, claim on asset. Number three, limited liabilities. Number four, voting rights in the firm. And number five, primitive rights in the firm. Claim on income. Stockholders has a claim on the firm's residual income. For example, the shareholders either receives cash payments in the form of individuals' dividends from the earning in the firm. Claim on assets. Stockholders has a residual claim on the firm's assets in case of liquidation. For example, if the company goes bankrupt, you will get some portion of the assets after paying the company's payable to the prepared shareholders of the company. Limited liabilities means stockholders' losses are limited to the amount of the original investment in the firm. For example, you are holding 10% share of the company which has 100 shares trading in the market. So if the company goes bankrupt, the maximum amount you will get loss, it is the value of 10 shares. Voting rights. Voting rights to the board for the firms and board of directors. For example, the shareholders express their opinion in the major decisions making for the company by voting. Example, get mergers and acquisitions, etc. Primitive rights, the shareholders may share proportionately in any new stock issues. For example, the shareholders of a company that grants them the rights to purchase additional shares in the company prior to the shareholders being made available for the general public to the purchase of in the investment of as a seasoned offering. So, common stock means shares whose owners have the last claim on the corporation assets and liabilities and who have voting rights in the firm. Now, it is time to clear about the concept of bonds. Key risks in bonds investment. To market price, the bonds will fluctuate with the demand for the bond, which in turn is closely related to the market interest rate. Let us look at the relationship between the market interest rates and bond price. Bond price has the inverse relation with the market interest rates. Let's start with a bond that is at par. When the interest rates rise, the bond's price will fall below par. If the interest rates have the following state, the bond's price will rise above the par. Assume the investors have the bond A. When the interest rates rise, bonds investors may want to allow their money B offers higher coupon rate. If the investor wants to sell bond A, he will have to sell the bond A at a discount to match with the return of bond B. That is why they consider the interest rate voluntarily as the K risks of bonds. That is why, since the changes in the interest rates directly affect the bond price through the demand for the bond, we can judge the interest rate risks of a simple bond through the measures called the modified duration. This measure speaks of the high sharp bond's price response to the interest rate changes. Bonds with a large modified duration have higher interest rate risks because the bond's price will fluctuate more and interest rate changes. Other risks that affect the bonds include default or cash risks, which exist as there is a possibility that the issuer may not be able to repay the investor. The amount of default risks depends on the financial stability of the issuer. For example, default risks of the government bonds is considered low because the most governments are that regarded as the financially stable. Government therefore typically issue the bond with the low coupon rates compared to the corporates within the same country. Corporates issue bonds with the higher coupon rates because they are considered as having the higher default risks than the government bonds. Credit ratings agencies such as the Standard & Poor's and Moody's and Fitch assign credit rating to the corporate bonds. These credit ratings allow the investors to judge the financial stability for the corporate issuer. Among the corporate bonds, these are from AAA to BBB are regarded as the investor grade bonds, and they have their own default risks than those rated as non-government bonds, which are below BBB. It is important to note that a credit rating it is not guaranteed to perform and can change over the life of the bond for the same company depending on the financial condition. Inflation risk is another key risk. So when we buy fixed coupon bonds, this is why because fixed coupon bonds are adjusted for the inflation over time. When the inflation increases, the investors can buy fewer goods with the same fixed coupon. If the inflation is a serious concern, you can consider investing in floating rate bonds where there is a coupon is adjusted for inflation over time. In summary, while there are various risks associated with the investment bonds investment, interest rate volatility remains as one of the important facts of this particular issue. So I hope so. This bonds is a bond means principal plus interest. Are certain, and here there is a concept is clear. That means a specific price of interest is write down on the bond, and at the end of the maturity you will get the principal plus interest. Now it is time to get idea about warrant. That means concept of warrant. Okay, why trading warrants? Advantage of trading warrants. The number of advantages of warrants is the gearing effect. In short, the warrants moves the gearing percentage than their underlying shares. So the shares goes up by 5%. It is not unusual for the company's warrants to increase by the 50%. Because of this, warrants allows investors the potential to increase their investment returns. As you know, warrants are priced at a fraction of the cost of their underlying shares. Because of this, their trading cost of warrants are much lower than if you would purchase the shares, which means profit potential for the investors. Now the warrants aren't only the securities that benefit from the gearing. Margin loans, CFD, and the futures do as well. But unlike those examples with warrants, even though your exposure to the underlying shares increases, your total capital risk is still limited to the amount you pay unfold. That means there are no margin calls. You will never be asked to bid. And if your initial investment turns out to be the importer, the ability to increase your effective exposure while limiting your capital risk has made the warrants very popular among the investors across the Asia. And you can buy the warrants over the both stocks and indices. While index warrants allow you to take a view of the market as a movie. With the index warrants, you will don't need. That means you worry company the announcement for the profit of warrants, and you simply choose with the directly you think that the market is headed, and you buy warrants that the matches your views. Index warrants are offered over the range of the different markets, allowing you to get the exposure and the non-permitting foreign stock markets without leaving a small share. For this reason, the index warrants are one of the most powerful tools for the warrants investors. And remember, you can choose the between call you the put warrants, and allowing the profit the both rises and the falls in the market. So warrant means the gearing. Warrant, where there is a warrant, there is a effect of gearing. That means when the shares will increase 5%, in case of warrant, gearing may adjust it with the 50%. So now it is time to calculate some maths so that we may understand very clearly at the same time what is the real facts in case of examination. You know very well these are the particular formula. Now, we have already discussed in earlier classes and earlier session. The particular formula we have to know, and even after that we have to calculate based on this formula. So let's go to the slide directly so that we may understand at the same time very clearly. Common stock. For common stock, we have to use this formula. That means dividend, current price, current market price, base market price, and we have to multiply by 100. For calculating bond, in place of dividend, we have to use I. I means interest. And in case of calculating warrant, we have to use C. That means cash receipt for a certain period. C means cash receipt for a certain period. Interest, I means interest for a certain period, and D means dividend for a certain. Dividend means current dividend. So P1 means current market price, and P0 means base market price. That means purchasing price. So we have to use this particular formula, the same formula. Actually, for calculating common stock, bonds, and warrant, we will use same formula. So let's go to solve a problem. And here there is a problem. Calculate the return. Calculate total rate of return. Actually, calculate the total rate of return for the following assets. Now we will calculate the respective maths for calculating the total assets on the base of total assets. Okay. So here there is a preferred stock bought for Taka 70 per share held 1 year, during which Taka 5 per share dividend are collected, sold for Taka 63. That means we have a prepared stock has bought by Taka 70 per share, 70 per share. Okay. It is mentionable that here a dividend, we know very well dividend is given for common stock. So here dividend has the mention the word dividend, so we will use the formula for common stock. Okay. Here 63 sold price, that means P1, and 70 is the best price, that means P0. Okay. And here current dividend is 5. That means D1 for dividend, current dividend. So it is clear, prepared stocks are bought for taka 70 per share, and in this case we will use for this formula. Okay, so the solution will be total rate of return for common stock D1 plus P1 minus P0 divided P0 multiplied by 100 for getting the percentage. Okay, it is very clear to us. I have already said that where there is a question of dividend, there is a formula, is you have to set the formula for common stock. Okay, D1 means how much amount? 5 taka per share. So the amount will be 5. And P1 means current market price. P1 means current market price. How much amount? That means selling price 63. We have to use 63 in place of P1. Even after that, the base price, that means purchasing price, how much amount? Purchasing price will be how much amount? Taka 70. Here purchasing price is more than the selling price, so the negative figure will come up maybe. Okay, so I hope so. Negative in this case, after calculating the respective maths, we will get minus 2.86%, minus 2.86%. Now this is the facts for problem 1, and now we have to look at the whole figure. Here Warrant bought for taka 11 sold 3 months later for taka 13. Okay, I have already said that as prepared or common, that doesn't matter, but dividend is mentioned in this math. These types of math has come to your examination in previous year, so this is very important for you to understand very clearly. Am I right? Okay, warrant, and in this case bond. Warrant bought for taka 11, and sold 3 months later for taka 13. What means 11 have letter, that means P 0, and okay, now for warrant. Okay, warrant will go for warrant, the calculation will be, we know very well, for warrant we have to use C, that means cash receipt of a certain period. How much amount? 0. As there is no figure is available on the math, this is why we have to use 0. Okay, P1, the figure will be 13, that means sold figure, that means current price. Sold figure means current price 13, and base price, in this case base price will be 11. So divided by base price will be 11, and multiply by 100 for getting the percentage. Clear? So what will be the figure? The figure will be respective figure, that means after calculating we will get 18.2 18 percentage, 18.18 percentage. Same formula, just we have to use C. Okay, for problem 3, a 12% bond bought for taka 870 held 2 years, during which interest is collected for and sold for taka 930. Okay, here the respective three figures has given 12%, 870, 930. Bought price, how much amount? That means base price, purchasing price is 870. Am I right? 870. Okay. So we'll use the formula for bond. The bond formula for bond is here. That means I means interest and current interest. I means interest in a certain period. How much amount? 12%. Okay. I means 12%. Okay. So here P0 means base price. That means sold. That means purchasing price. How much amount? 870. No, actually here purchasing price will be 930 is the current price. Sold price is 930 and purchasing price is 870, and here 12%. How much percentage? 12%. Okay, interest is 12%. Clear? Okay, 12%. 12% is the current. 12% is the current. 12% is the percentage. 12%. Okay, 12%. Just for the season of being for very clear. 12%. Point shares and 90. Okay. So 120 plus 60. 120 plus 60. 870. Okay, 870 and multiply by 100. 4,000 shares. So now 12%. 90. Okay, 20.69% is the answer. 20.69% is the answer. So this method very easy for you to understand. The formula is simple, same formula, just D1, C1, P1, D1, C1, P1. So it is very clear now for you to understand. For our 12% bond for taka 870 held 2 years, during which interest is collected and assessed for 930. So hope so you understand all things at the same time. So these are the procedure for calculation common stock bonds and warrants. So dear participants, I will suggest my beloved learners to subscribe my channel so that you may get forwarded my upcoming videos.